Welcome to the deep dive. Today we are taking a deep breath and a really close look at a company that just seems determined to defy financial gravity. Robinhood Markets.
Yeah. Good.
We're diving into a stack of sources here that try to explain exactly how this fintech powerhouse managed what one analyst called a scorching hot September.
And not just September, the whole year-to-date growth have been real astonishing.
Absolutely.
Really is a phenomenal story to unpack, mainly because, the whole narrative around Robinhood, ticker, Hood, it shifted quite a bit.
How so?
Well, it's not just that volatile retail darling from the pandemic days anymore. Our sources are showing a company that's genuinely transitioning.
Okay.
It's being backed now by massive institutional validation, real operational strength that you can see in the numbers, and this relentless push for innovation. Very aggressive.
Right. And that's pretty much our mission today, to give you, the listener, a clear, structured understanding of those three primary catalysts driving this, vertigo-inducing surge.
Vertigo-inducing is a good word for it.
Yeah. We're going from those external boosts, like the index inclusion we mentioned, right through to the nitty-gritty operational numbers, and then looking at their bold new product plan.
The goal is clarity, right? Structured knowledge, context on why this stock, which still feels pretty high risk, let's be honest.
Definitely high risk.
Why it's become one of the most talked about plays on the market right now.
And we absolutely have to start with just the sheer scale of this surge, because the numbers, frankly, are staggering.
They really are. In September alone, Hood stock shot up a blistering 38%.
38% in 1 month. I mean, just to put that into context for everyone listening, the S&P 500, the main benchmark index.
Right, the big guys.
It rose a respectable, sure, but kind of distant 3.5% during that exact same period.
So Robinhood just crushed the market, outperformed by, what, a factor of 10? More?
Yeah, easily. And that signals a pretty fundamental shift, in investor confidence, maybe institutional demand too.
And if you zoom out from just September, that performance really cements a spectacular year. Year to date, as of when our source material was written, it's up a blistering 263%.
263%, wow.
Yeah, this isn't just fleeting excitement over some penny stock. The current market cap is sitting at a massive $115 billion. This is a major financial institution in the making, or at least that's what the valuation implies.
And when you look at that 52-week range, from a low of $23 to a high of $153.86.
Ooh, whoa.
It just screams volatility, right? But also massive investor excitement.
It tells you the market really believes in that high-risk, high-reward bet that seems inherent in the stock.
Yeah, and the sources we looked at capture this perfectly. They cite the company's restless search for new revenue streams and innovative ways of thinking about its business. That seems to be the core attraction.
That restlessness, plus the sheer financial weight we're seeing now.
Yeah.
Yeah, it makes this deep dive pretty essential.
Okay, let's unpack this. Starting with, I think, the single most powerful external catalyst, the one that gave Robinhood that institutional legitimacy and really picked off the September rocket ride. So the first major catalyst, the big institutional seal of approval that landed at the end of the first week of September, right? Inclusion in the S&P 500 index.
That's the one. And it's huge. It really is the gold standard of financial validation for a public company.
S&P Dow Jones indices, during their regular quarterly rebalancing, they officially tapped Hood stock, said, okay, you're in the S&P 500 now.
Yep, and the change became effective September 22nd. That date really marks the start of the big institutional rally phase.
I thought the detail about who they replaced was interesting, too. Robinhood basically elbowed out Caesars Entertainment, the casino operator.
Yeah.
There's a kind of powerful metaphor there, isn't there? Moving from that regulated brick-and-mortar world of traditional wagering to this new, digitized, often very high-stakes world of modern fintech.
That parallel is, extremely apt. It really speaks volumes about where capital seems to be flowing these days.
But okay, to really understand why this announcement led to a 38% jump in just 1 month, we need to look past the metaphor, right? Get into the mechanics.
Exactly, and the sources are spot on here.
Yeah.
Being included in the S&P 500 barely affects a company's fundamentals, if at all.
So Robinhood didn't suddenly start making more profit or get better management overnight just because they got into the index?
Not at all.
So if the fundamentals don't change, what actually forces the stock price up so much? It seems counterintuitive.
It's all about mechanical demand, pure and simple. Think about the index itself, the S&P 500.
Okay.
It's tracked by literally trillions of dollars in assets around the world. We're talking passive index funds, huge ETFs, big institutional mutual funds, pension funds.
Right, a massive pool of capital.
A massive pool. So when S&P Dow Jones Indices makes that official announcement, every single fund manager whose mandate is to track that index, well, they have to adjust their portfolios.
They become forced buyers, essentially. You don't have a choice.
Exactly right. They aren't discretionary buyers doing deep fundamental analysis on Robinhood at that moment. They must buy the stock to maintain balance in their fund and accurately replicate the index's performance.
So the sheer volume of that required buying just creates this huge upward pressure on the stock price.
Immense pressure. Robinhood becomes a, quote, prime target overnight for trillions of dollars under management. This is mandatory institutional money flowing in, whether they like the stock or not, at that price.
Can we even, guess at the scale of that forced buying? Is it significant?
Oh, yeah. Our sources suggest that for a company of Robinhood's size, with its specific weighting within the index once it enters, the mandatory purchase volume from just the passive funds alone can easily run into tens of millions of shares.
Wow.
Which translates into potentially billions of dollars in buying pressure, concentrated in a pretty short window, usually between the announcement date and the effective date, the September 22nd date.
Okay, that explains the initial spike almost perfectly. It's like creating an artificial but very powerful demand curve, just out of thin air because of the index rules.
It does that, but it also does something else, arguably more important long-term. It provides a level of institutional visibility, maybe even stability, that Robinhood just didn't have before.
Ah, interesting. How so?
Well, think about it. For years, the story around Hood was driven mostly by, small retail traders, social media hype, meme stock status sometimes.
Right, the Wall Street bets crowd effect.
Exactly. This S&P inclusion shifts that narrative completely. It adds this layer of sophisticated, maybe longer-term institutional validation that retail enthusiasm alone just could never provide.
So it opens the door for more conservative funds, funds that maybe couldn't touch it before because it wasn't in the S&P?
Precisely. Funds that have mandates only to invest in S&P 500 components, for example. Suddenly, Robinhood is on their radar and potentially in their portfolios.
Okay, so we've got this massive external catalyst. This flood of institutional legitimacy hits the company early September. The market gets excited. But, excitement alone doesn't usually sustain a rally like that for long.
Sure.
You need proof that the engine inside the company is actually firing, right? Which leads us perfectly to the internal operational strength that they revealed shortly after that index news.
That's the key link right there. The market reacted to the S&P news, that big external push. And then, almost right on cue, Robinhood drops its monthly operational update.
Perfect timing.
Impeccable. And it provided the sort of fundamental confirmation the market needed to see to keep that momentum going.
Okay, let's start with the foundation then. The customer base. What did the update say about funded customers?
A tally hit 26.7 million funded customers. Now, that represents a solid 10% rise year over year.
10%. Okay, so it's not like explosive exponential growth in user numbers anymore, maybe?
Not explosive in percentage terms compared to the early days, no. But it proves the client base is still actively growing, consistently adding new accounts. And maybe more importantly, it suggests they're retaining existing ones pretty well. They're maintaining that market penetration.
But, customer acquisition is only half the battle, isn't it? Especially for a brokerage that's mostly commission-free.
Right.
The real question is about engagement. Are those 26.7 million customers actually doing anything? Are they using the platform actively?
And the sources really stress that the answer there is a resounding yes. The growing client base is also, and I quote, spending considerably more on trades.
Okay, spending considerably more on trades. In Robinhood's world, how does that translate into revenue potential, given the commission-free model for most equity trades?
Yeah, this is where we need to dive a bit deeper, because the activity levels they reported truly surged. Let's look at equity trading volume first.
Right.
It more than doubled over the stretch, hitting a staggering $199 billion.
Wow, nearly $200 billion in equity volume in a month. That's immense velocity. But back to my question, since it's mostly commission-free, how does that volume make them serious money? Is it just about payment for order flow, PFOF?
That's an excellent question, and it really cuts right to the heart of their business model. So for Robinhood, that $199 billion in equity volume means two primary things revenue-wise.
Okay.
First, yes, absolutely, it drives payment for order flow. When you make a commission-free trade, Robinhood routes your order to a market maker, like Citadel Securities or Vir2.
Right.
Those market makers pay Robinhood a tiny fraction of a penny per share for that order flow, because they can potentially profit from the bid-ask spread. So doubling the volume to $199 billion essentially doubles the potential revenue from PFOF right there.
Got it. So sheer volume is revenue in that sense. The more active the users, the more PFOF they generate, even without charging direct commissions.
Exactly. But second, and this is also crucial, that level of activity, that doubling of volume, strongly suggests increased engagement with their premium features too.
Oh, okay. Like what?
Like users who trade more frequently are often the same users who engage with margin trading, borrowing money to trade more.
Which generates interest income for Robinhood.
Correct. High margin interest income. Or they might subscribe to services like Robinhood Gold, which has a monthly fee and offers more data, research, and higher instant deposit limits.
Right.
Or they might be getting more into options trading, which, while often commission-free too, has its own complexities in execution and can generate revenue in different ways, plus it often goes hand in hand with margin use.
So high volume isn't just PFOF, it's a signal of a deeper, stickier client relationship that opens up other, potentially higher margin revenue streams.
Precisely.
Yeah.
It indicates high engagement across the platform.
Okay, that makes sense. Now, beyond equities, the sources also highlighted their crypto business. Still developing maybe, but showing an even sharper growth path.
Indeed. Cryptocurrency trading volume, it heated up significantly, reached just under $14 billion in the period.
So smaller than the equity total, obviously.
Much smaller, yes. But the growth rate is what's phenomenal here, a robust 154% year-over-year gain.
Whoa, 154%.
Yeah, that reflects a major trend, I think.
What's fascinating here, then, is that clear correlation you see between steady customer growth at 10% and this really exponential increase in trading volume, especially in crypto. It suggests engagement per user is just spiking. Right?
Exactly. That 154% crypto surge particularly indicates that the typical retail investor using Robinhood is getting increasingly comfortable moving beyond just traditional stocks.
Yeah.
And Robinhood is just perfectly positioned to capture that more volatile, potentially high growth activity in assets like crypto.
And we absolutely have to emphasize the context our sources provided here, which makes these numbers even more impressive.
Right. Good point.
This strong activity, the doubling of equity volume, that massive crypto spike, it all happened even though August 2025 had one fewer trading day compared to August of the previous year.
Which means the daily average intensity, the frequency of trading per user, must be even higher than those raw monthly numbers suggest.
Yeah. So the takeaway is that the current customer base isn't just large, it's becoming highly transactional. It's the operational proof the market needed that the business model, leveraging PFOF, premium services, high engagement, is actually thriving.
It really shores up the bull case right after the S&P news provided the institutional legitimacy.
Yeah.
And that combination, the strong operational performance landing right after the huge institutional list from the S&P inclusion, well, it created an almost irresistible narrative for Wall Street analysts.
Yeah, they couldn't really ignore the momentum anymore, could they?
Not really. And we saw some immediate and pretty substantial bullish adjustments in their ratings and price targets.
Right. The example given was Craig Siegenthaler at Bank of America Securities. He's a pretty key voice in the financial sector.
He is.
And he became notably more positive. Raised his price target quite a bit, actually, from $119 up to $139 per share.
That's a significant jump.
And importantly, he reiterated a buy recommendation. So this wasn't just minor tweaking, it was a real revaluation of the company's potential based on recent events.
And interestingly, the basis for that revision wasn't just looking backward at the S&P news or the August numbers. It was very forward-looking.
How so?
It stemmed directly from a series of presentations Robinhood's management made at their annual Active Trader Summit, which happened in Las Vegas.
Ah, okay. So analysts liked what they heard about the future plans.
They were clearly impressed by what the sources called management's clear hunger for innovation. And this brings us directly to the third core driver of this whole story, that robust and, frankly, pretty daring product pipeline they laid out.
Right. This feels like where Robinhood is aggressively signaling its intent to move beyond just being the platform for beginners.
Exactly. They want to capture the entire financial life cycle of that modern digitally native investor.
So what specific product launches or plans really fueled this positive market sentiment coming out of that summit?
Well, their strategy seems to be kind of twofold. First, enhance the core trading experience, especially for more sophisticated users. And second, expand into completely new, potentially high-growth revenue territories.
Okay, so on the core enhancement side.
We see things like plans for extended hours for trading index options. That caters directly to that growing group of users who want to move into more complex strategies.
Like hedging or more speculative short-term plays using leverage, that kind of thing.
Precisely. They're basically trying to grow with their user base,
Hmm.
catering to the user who maybe started buying their first fractional share of Apple a couple of years ago,
Uh-huh.
but now wants to engage in more complex multi-leg option strategies.
Mm,
They don't want to lose that user to a more traditional broker as they get more sophisticated.
makes sense. Keep them in the ecosystem. What else?
And they're also adding Robinhood Social,
Mm.
a planned social media function right within the app.
Interesting. Why is that important?
Well, it's key for stickiness, right? Trading has become incredibly social. People discuss their moves, they follow influencers, they look for community validation or ideas.
Yeah, look at Reddit, Twitter.
Exactly. So by integrating a social function, Robinhood aims to capture that conversation inside its own ecosystem. It increases user time spent on the app, potentially leads to more trading ideas being shared and acted upon.
And probably captures valuable social data too, right? Feeds back into their understanding of market sentiment, maybe helps target products.
You'd have to assume so, yes. But the really big one, the one that signals a major shift towards attracting a more professional, maybe capital-heavy client base, is the introduction of short selling.
Ah, right. That was highlighted as a potential wide revenue stream at the summit.
Absolutely. Introducing short selling, the practice of borrowing stock and selling it, hoping to buy it back cheaper later.
The classic way to bet against a stock.
Exactly. It's a fundamental trading method.
Yeah.
But for Robinhood, offering it easily is actually pretty revolutionary for their platform. Why? Because it inherently requires margin accounts and the leveraging of capital.
Okay, so how does that specifically translate into potentially massive new revenue for Robinhood?
Primarily two ways. First, and most obviously, margin interest. When customers borrow securities to short them, they're essentially taking out a loan from Robinhood.
Right.
And Robinhood charges margin interest on that borrowed capital. That's a highly reliable, recurring revenue stream, potentially very high margin.
Okay, interest income. What's the second way?
Second, there's execution complexity. Short selling often involves more complex order routing, locating shares to borrow, and clearing processes compared to a simple buy order for stock. This can sometimes carry different internal fees or perhaps different PFOF arrangements or rates than a simple long equity purchase. It's a much more involved process operationally.
So it's a targeted move then. It attracts the market bears and hedgers, as the source puts it, allows them to, quote, run free on the platform.
But crucially, while generating potentially high-value, high-margin revenue for Robinhood in the process, through both interest and possibly execution dynamics,
It effectively positions them, or aims to position them, as a full-service platform, catering to all market views, bulls, bears, and those looking to hedge.
that seems to be the goal. And their appetite for new territory doesn't even stop with traditional trading methods like shorting. There were later reports, specifically from Bloomberg, about them exploring the prediction market frontier.
Yeah, prediction markets. That sounds edgy. Initially focused on overseas clients, though, right?
That's right. This is maybe the most aggressive move towards, well, the future of finance, potentially blurring the lines between traditional trading and wagering or speculation.
So Bloomberg reported Robinhood might grant access to these prediction markets, partnering with specialists.
Yeah, they mentioned two specialists specifically, Kalshi and ForecastX.
Okay, so for listeners who aren't familiar, what exactly are prediction markets? How do they work?
Essentially, they allow users to trade contracts based on the future outcome of specific real-world events. So you might bet on, say, will the Federal Reserve raise interest rates at its next meeting? Or will this particular piece of legislation pass Congress by X date? Or even things like election outcomes.
So you're basically investing or wagering on the probability of future events happening. What's the strategic significance for Robinhood getting into this?
Well, the sources highlighted that these partners, Kalshi and ForecastX, have actually seen some success lately, partly due to what they termed an increasing appetite for wagering in the U.S. and globally. The significance is that Robinhood seems to recognize that a large segment of its user base perhaps views trading itself as a form of, let's say, high-stakes entertainment or informed speculation, not just long-term investing.
And prediction markets meet that demand head-on.
Directly. By exploring prediction markets, they're tapping right into that desire for event-driven speculation.
But these markets often operate in a pretty complex regulatory gray area, don't they? At least in the US. They're sometimes seen differently than traditional securities.
That's a huge factor. Prediction markets are often viewed by U.S. regulators as being closer to gambling or derivatives than traditional investments, although some platforms have managed to secure limited regulatory approval from bodies like the CFTC for specific types of contracts.
So is that why the initial focus seems to be on overseas clients? To sidestep immediate US regulatory hurdles?
Almost certainly. By targeting overseas clients first, Robinhood can test the waters, figure out the operational procedures, gauge the user appetite, and build the tech,
Mhm.
all while minimizing that immediate regulatory friction back home in the U.S.
Smart. It positions them to be a potential first mover if, or maybe when, the regulatory environment for these things shifts or becomes clearer in the States.
Exactly. It really solidifies that narrative we talked about. Robinhood isn't just fighting for market share in established markets like stocks and options. They are actively trying to build and claim the next generation of speculative revenue streams, potentially on a global scale.
Okay, so we've spent a good amount of time detailing these three massive tailwinds, right? You've got the institutional legitimacy from the S&P inclusion,
Now,
the confirmed operational strength showing users are super active,
double check. High volume, high engagement.
and this really aggressive, forward-looking innovation
Yeah,
pipeline.
short selling, prediction markets, the social stuff.
And that combination really does explain the excitement, the buzz around the stock. But now we absolutely have to shift focus to the other side of the coin, the cost of all that excitement.
The risk.
The inherent financial risk that's just baked into the current valuation. The sources didn't mince words, describing it as vertigo-inducing and super expensive.
Yeah, vertigo-inducing feels about right. Because while the growth story is undeniably thrilling, any, seasoned investor has to look at the traditional valuation metrics. And they
Yeah.
reveal that investors are paying a colossal premium for a hood stock right now. If you buy it today, you are fundamentally betting on flawless execution and sustained hypergrowth for years, probably decades to come.
Okay, let's lay out those specific metrics just so our listeners really understand the scale of this high wire act. We can start with the forward price to earnings ratio, the forward PE. That measures the current stock price relative to its anticipated future earnings.
Right.
For Robinhood, at the time of the source material, that forward PE was nearly 71.
71, yeah. That is just an astronomically high figure in most contexts.
Put that into perspective for us. What does a PE of 71 actually imply?
Well, it implies the market expects Robinhood's earnings to grow exponentially, just incredibly rapidly, far beyond typical market or even typical tech growth rates, simply to justify today's stock price. You're effectively paying $71 today for every dollar of profit the company is projected to make next year.
Hmm.
That represents massive expectation risk. If Robinhood stumbles, if they miss earnings estimates even for one quarter, or if that growth trajectory slows down, that huge valuation premium could just collapse very, very quickly.
Okay, PE of 71. Then there's the price to book value, or PB, that compares the company's market price to its net assets, its book value on the balance sheet.
Right, what the company is technically worth in assets minus liabilities.
That figure for Robinhood was more than 16.
Again, incredibly high. A PB over 16 suggests the market is valuing Robinhood's intangible assets, things like its brand recognition, its technology platform, its user base, and crucially, its future customer acquisition potential at 16 times the value of its current physical and financial assets.
So these aren't the metrics you'd see for a stable, mature value company.
Not even close. These are the classic metrics of a high-risk, high-growth technology stock where the market believes it's going to fundamentally disrupt an entire industry and capture enormous future value that isn't reflected on the balance sheet today.
Now, to really drive home just how lofty this valuation is, we need to compare it to its peers, which the sources thankfully provided. Let's start with another sort of similar next-generation fintech company, SoFi Technologies.
Right. SoFi also focuses on younger demographics, digital-first banking and investing, definitely a growth-oriented fintech.
But its valuation.
Far more grounded, relatively speaking. SoFi was trading at a forward PE of around 47 and a price to book well under 5.
Okay, so still high compared to, say, a traditional bank, but significantly lower than Robinhood's 71 PE and 16 PB.
Exactly. Even within that high-growth fintech space, Robinhood commands a really significant, noticeable premium over its contemporaries like SoFi.
And that contrast just becomes incredibly stark when we look at the established brokerage landscape, right? embodied by a giant like Charles Schwab.
Oh, yeah. Schwab is kind of the definition of a mature, incredibly efficient, highly profitable, traditional brokerage firm. Massive scale.
And Schwab's valuation tells that story of stability and operational efficiency, doesn't it?
Absolutely. Schwab had a forward PE of just 17 and a price to book just under 4.
Okay, so Robinhood's forward PE is roughly 4 times higher than Schwab's, and its price to book is also about 4 times higher.
That massive premium Robinhood commands over a giant like Schwab. Well, that is the market's calculation, or maybe gamble, on Robinhood's disruption potential.
The market is basically saying that Robinhood's speed, its appeal to younger investors, its volume growth will somehow allow it to fundamentally change how brokerage and maybe even banking services are delivered over the next decade, justifying that huge difference.
That's the bet embedded in the price, yes.
So, okay, given these really high wire valuations, I have to kind of challenge the premise a bit. Why are investors willing to pay this colossal premium? Why hasn't the stock corrected downwards to maybe a more reasonable high growth multiple, like a 40 or 50 PE? What's holding it up there?
The justification seems to be entirely focused on the future, on market share capture, and on that pulse of the modern investor idea.
Explain it.
Our sources basically argue that if you look at the three companies we just mentioned, Robinhood, SoFi, and Schwab, Robinhood is the one that seems to have its finger more firmly on the pulse of what modern investors want. Meaning its user experience, its mobile-first design, its early embrace of crypto, its generally lower friction for opening accounts and trading. All of that resonates incredibly well with a younger, digitally native demographic. It's less about how much money they're making today per customer and more about the belief that they will own the primary financial relationship for the next generation of investors.
And that huge 26.7 million funded customer base, the one that's demonstrably trading considerably more, that's the proof point for that argument.
That's the key exhibit, yes. Their offerings, the slick UI you mentioned, the easy access to crypto, now the plans for shorting and even prediction markets they have, as the source said, clearly struck a chord with the market.
So investors are willing to overlook the current extreme valuation metrics because they perceive Robinhood's market strategy and its ability to engage customers as basically peerless, at least in capturing that specific high-growth demographic.
It's a risk calculation, definitely. Institutional investors seem willing to tolerate that extreme valuation risk because the potential reward, if Robinhood does become the dominant platform for Gen Z and millennial investors, is just enormous. They're essentially betting on explosive future earnings growth, allowing Robinhood to eventually grow into that massive $115 billion market cap.
Which is why, despite acknowledging the high-risk metrics, the overall sentiment in the sources leaned positive, concluding it still has plenty of upside and maintaining that buy recommendation.
That seems to be the rationale, yes. The momentum from the S&P inclusion, combined with the operational proofs and the exciting innovation pipeline, outweigh the valuation concerns for those analysts, at least for now.
So what does this all mean, then? It means the market seems to believe Robinhood's aggressive innovation, pushing into short selling, prediction markets, constantly refining the user experience, will unlock new, potentially high-margin revenue streams.
Streams that maybe traditional brokerages haven't really tapped into effectively yet.
Right, and that will allow Robinhood to rapidly grow their earnings per share and eventually maybe somehow justify that very demanding PE ratio of 71. It's a big bet on future execution.
A very big bet.
Wow. Well, this has been a really fascinating deep dive into how a stock price can be driven by such a potent mix of factors, hasn't it? You've got institutional validation, meaning proven operational activity, all fueled by a very future-focused product roadmap.
Yeah, it's a great case study. If we synthesize those three main drivers again, first you had that external validation. The S&P 500 index inclusion provided that instant mechanical lift, sure, but more importantly, it forced a kind of institutional legitimacy onto the stock, raising its profile globally.
Right. Open doors. Second, you had the operational success. That demonstrated the platform's stickiness, didn't it? Doubling equity trades to nearly $200 billion, seeing crypto volumes spike 154%. That confirmed the massive customer base is highly engaged.
And crucially, generating high-velocity revenue, whether through PFOF or increased use of margin, options, and potentially subscriptions down the line. Real money being made from that activity.
And then finally, that third piece, the aggressive innovation pipeline. especially highlighting the high revenue potential they see from introducing short-selling access and that frontier push into things like prediction markets.
That's what really fueled the analysts' optimism, the target price raises, and ultimately, it's the only real justification anyone can offer for those demanding admittedly super expensive valuation metrics we just discussed.
And the relevance, I think, to you, the listener, is pretty clear from this. This case study really demonstrates how non-fundamental external factors, like something as simple as index inclusion, can sometimes instantly override traditional valuation concerns, at least in the short term.
Yeah, and it also shows that in modern finance, maybe a relentless focus on capturing the demands of that digitally native investor, even if it means pushing into riskier or newer revenue streams, is what really captures massive market enthusiasm and those high-growth premiums we see.
It's about meeting users where they are, even if where they are is asking for more speculative tools.
Which leads us directly to maybe a final provocative thought for everyone listening, something that builds on this whole discussion, particularly Robinhood's aggressive pursuit of these modern, sometimes quite speculative trading methods.
Like the prediction markets we talked about, and just the general surge in trading volume overall.
Right. The sources pointed repeatedly to this idea of an increasing appetite for wagering among modern investors. Not just investing, but wagering.
So the big question for the long-term future then is this. As Robinhood continues to expand access to increasingly complex, potentially high-risk speculative products, easy margin access, complex options, short selling, eventually maybe even prediction markets.
Does this fundamentally change the behavior and maybe the overall risk profile of its now highly active 26.7 million strong customer base?
Is the direction of retail finance inevitably heading towards normalizing complex leverage speculation for the masses, making it as easy as ordering food delivery?
And if so, what are the broader financial stability implications? Not just for Robinhood, but for the system. What happens when millions of users who are already trading considerably more are suddenly offered every possible avenue for betting on almost any market outcome?
Yeah, that's definitely something to chew on. What are the long-term implications of that shift?
A question for another time, perhaps.
Indeed. We'll leave you with that thought. Thank you for joining us for the deep dive.